Hi everybody, my name is Mary Redmond and I'm talking right now about the Australian dollar US dollar. So for the coming week I still favor this to the downside, and I think we're in a transitionary phase right now in the financial markets, the stock and the Forex markets. And essentially we've had an incredible run in risk appetite, we've had an incredible run in commodities and stocks and in the foreign exchange carry trade. And I think we're entering what could be a period of uncertainty, a transitionary phase which could possibly be to a medium-term downturn in those particular elements, both in the stocks and commodities and the carry trade. And the reason we're entering a transitionary phase is because the Federal Reserve has set the departure point for its QE3. They're going to continue the program until the end of June, and then they're going to finish it. And Mr. Bernanke, in the last few speeches he's given, has given a pretty clear indication that they're definitely not going to begin any other quantitative easing programs, at least not right away. And people are always going to speculate on QE3, but you know, the Fed doesn't really know any more than anybody else does exactly how the stock market or the economy is going to respond to the cessation of the liquidity program. And they've kind of jump-started the job market, they've given the economy a boost, and everyone wants to see if the U.S. economy is going to continue to grow and continue to generate jobs. So there's some uncertainty there. And of course, if you listen to the financial news or read the financial papers, you're going to be constantly hearing about the European debt issues. So that's putting a lot of uncertainty in the financial markets too. And while the Greek bailout terms haven't completely been finalized, it's pretty clear that the EU is going to give Greece the additional loans that they need. And while Moody's has threatened to say that any type of restructuring would be considered a default, that might not make that much difference because the bonds are almost priced as if they're junk bonds now, with a yield of 25%. So the real issue going forward is how is this going to affect the EU growth rate and the European economy, and how many other countries are going to need bailouts. That's the real question, because they have the $750 billion European Financial Stability Fund, and if they had to, they could increase it. But of course, the more money they have to put into this, the more money is unavailable for other additional government resources. And of course, these austerity budgets, which are being imposed on some of these European governments, are resulting in a slow rate of economic growth and even contraction. So that's adding to market uncertainty. But when you talk about the Australian dollar, it's really responds more to what's going on in the Asian economies, China and Japan. And I think some of the real uncertainty in the Australian economy could be coming from the concern about exactly how much these Chinese reserve requirement hikes are going to affect Chinese growth going forward. So you have to realize that the Chinese have hiked reserve requirement ratios by 50 basis points, and they've done it 8 times since October 2009. So that's really very dramatic. And if you look at the way the other central banks raising lower rates or reserve requirements by 25 basis points, the Chinese are being very aggressive, and they'd rather err on the side of causing a downturn in the economy just to control inflation. And they're very, very concerned about inflation and social stability. And of course, China's really in a multi-decade growth cycle, but within it, that doesn't mean that there can't be slowdowns. So, and nobody knows exactly how much this is going to affect the Chinese economy. We've seen some of the economic reports come in slightly lower than they were in previous months, but some of these rate hikes don't start to take effect until 3 to 6 months or even later. So we may be just starting to see the effects of the hikes that occurred in 2010. So that's causing real uncertainty. And I think that may have been reflected in the Australian jobs report. Since the last 2 months, the previous month, the Australian jobs report showed a loss of 57,000 jobs, and this month showed a gain of only 7.8 thousand, with a gain of much more part-time jobs than full-time. So it kind of seems that the Australian employers may be waiting and watching to see how these Chinese rate hikes affect the growth of their customers, and they're waiting to see if they're sure they're going to be getting the same orders that they were previously before they commit to hiring new people. And of course, Governor Stevens did talk a little bit about that and express some concerns about Australian growth going forward. So there's that, and then you also have the just the general pullback in the stock market. So this wasn't really a complete liquidation as of yet. It was basically a 5% pullback in the stock markets. You can see that, actually higher than 5%, but you can see that the S&P made a very bearish close, and it broke below 1280, which is an important support line. And now it's looking as if the next support line is going to be the 1250 area. So I really wouldn't be surprised if we saw that in the next week or two, because sell-offs are usually a lot faster than bull markets. Bull markets proceed on a fairly slow, even steady pace, but sell-offs are always quick. And we saw the point and figure chart for both the Dow and the S&P are showing bearish reversals. So the bearish price objective for this is 1160 on the S&P, and that's another 10% pullback. So we'll see what's going to happen there. But basically it indicates that, you know, the fund managers, the people who really impact the market the most, are the ones who are looking to take profits and capitalize on this great bull run before something else happens. I mean, nobody's really sure what's going to happen. And you want to look at, with the Australian dollar, I like to look at copper, because I think it gives a pretty good indication. It's a pretty good leading indicator for the Australian dollar. And if you look at here, right around the end of 2008, you can look at the area which was February 09. Copper prices began this huge run up, and that was right before the Australian dollar began its huge run up in March of 2009, which was back at 62 cents, and it's really been, you know, over a 2-year run. So the copper prices right now, in my opinion, they look like they're beginning to slow down or beginning to turn down. So this is something that would be good to monitor along with the gold and silver. And if you look at the weekly chart of the Australian dollar, it does still look like it's on a weekly upward trend. And until it breaks below this line and makes a clear, decisive break, it'll still be on an upward trend. So if you look at the closer chart, the top of this channel is right around 107, but there's also a tighter channel that's formed over the last week, and you can see that I think with the market sell-off, it's possible we could go down to the bottom of this channel, which would be approximately 105. We also have to see there's an important support level just between 104.5 and 104.75, and there's a gap here. So if we were to break below that and make a decisive break and say move down to what would probably be below the 200-day moving average of 102, then we would probably be in a downward trend at that point. You can't really say it's in a downward trend right now, even though it's in a downward channel. So I do have a short in the Australian dollar, although I'm not telling anybody else what to do, but I'm just saying I favor this to the downside. If it were to make a spike upward to the 106 level, I would favor shorting it again. And another good indicator, an important indicator to watch for the Australian dollar, is the volatility index. And what we're seeing this week, we're seeing a move up in the moving average of the volatility index, which means we're transitioning possibly to a different phase in the market. And we did see the VIX move up to the 19 level this week, which previously, 6 months ago, it could have meant a 19 level was a good buy for the Australian dollar. But since we're moving to what could be possibly a different phase in the market, we may have to see this type of a spike up, a real spike up in volatility to the 30 level before we see another buy for the Australian dollar. So that's what I'm thinking for this week, and it's also important to keep an eye on the economic reports that are going to be coming out, because there's a lot of reports from China coming out this week, and particularly the consumer price index and the producer price index. So if you see a slowdown in growth in China, but you also see the consumer and producer prices continue to go up, well, that could be real trouble for the Australian dollar, because that means that there could be even more rate hikes to come. And then you also have there are some other economic reports coming out. Of course, you've got the Australian dwelling economic report. And since there is a downturn in the Australian dollar housing market, it's good to keep an eye on that. There's dwelling starts, because if it gets to be extremely, very high, it could be the indication of a more prolonged contraction in the housing market. So either way, those are the things to keep an eye on for this week.